Hey guys, it's Rahul, and today we have here a returning guest. He is Jordan Roy Byrne. He's over at the Daily Gold. Thanks for coming on again, Jordan.
Thanks for having me, Rahul.
All right, so you're one of the technical analysts that I follow on a frequent basis, and I noticed that there was a slight change in your tune in September of this year, and it seems like you were turning a little bearish while many people were turning bullish. So what was your thought process behind it, and where do you see the next levels in the gold price then?
Well, my thought process behind it, to sum it up, was that if you look back at the month of September, of course, historically, it tends to be a strong month for gold, but if you look back at the last 10 years or so, September happens to be a very important turning point. It can be an inflection point in both directions. It's led to very important breakouts in the market, and also it's led to severe declines. So leading into September, I really liked the way that the mining stocks were acting. They were holding up pretty well, and as we know, the mining stocks tend to lead the metals, and I was thinking, okay, this looks good. The mining stocks are in position to break out in September, and then the metals will follow suit. Well, that obviously did not happen. The first week of September was a total disaster. You had huge selling, and basically you had a failed breakout attempt in the miners, and that was a bad sign because gold itself was looking pretty weak. Technically, even in August, I believe gold had fallen below its 50 and 200-day moving averages. So that was a concern. Again, at that time, the mining stocks were showing good relative strength. Gold priced against other currencies was actually looking fairly strong. So that was something that the bulls could hang their hat on. Yet, when we saw the failed breakout in the stocks, you couple that with the fact that gold was technically weak, that just told me that gold's going to go to that 1,000 and test that level. So that's kind of why I changed my thoughts. Just failed breakouts are very negative. And looking in the very big picture, the mining stocks had been leading this bear market, and in the summer of 2013 and then in December of 2013, they became extremely oversold. And at those times, it was very easy to make a case that they're going to have a pretty big rally, and this looks like it could be the bottom. They did have a big rally, but at both those bottoms turned out not to be the bottom. And now during the time when the mining stocks were rallying, the issue with gold was still looking really weak. And if you looked on a historical basis, I often post these bear analog charts. The bear analog chart for gold showed that gold could decline to 1,000 or 1,050 pretty easily, and that would be more in line with history than gold declining to 1,200 and the bear market ending there. So essentially, technically the reason to be bullish before September was you had the mining stocks holding up very well. As I already said, the mining stocks failed to break out, and then that really shifted the weight of the evidence to the point where it was clear that this bear market was not, it was going to continue. It wasn't over yet. And as far as targets, one thing I like to look at when a market is very oversold, I want to look at where is the really strong support. Now, you're looking at the gold chart, the very strong support, in my opinion, is at 1080, which is the 50% retracement of the entire bull market, and then also 1,000, which is a psychological level, and then it was a major breakout point after we had the last bear market in gold, although that was a very, very short bear market there in 2008. So those are the targets that I'm looking at. Gold technically just looks terrible. It broke to a new low last week. And also, when gold rallied a couple weeks ago for 2 weeks, the stocks did absolutely nothing. They barely rallied. All the strength was being sold. So the action in the stocks in the last couple weeks was really telling us gold is going to break below 1180 and go to 1,000. Now it's It closed, I believe, around 1170 on Friday. I checked it an hour or so ago. It was down in the 1160s. It's just very weak, and I think in this week we could see a plunge below 1100. So I'm kind of looking for gold to settle maybe 1050 to 1080, but ultimately I think it's going to bottom around 1,000. I would not be surprised if it printed a 9 handle as the absolute low price.
That's really interesting how we've seen a turn of events in the gold market. But adding on to this, do you see some of this price action due to just weak hands right now, just scared out of their minds, they're on margin, and they're just like, you know what, we think it's going to go well below 1,000, and it's time for us to get out. Do you see it that way?
Well, what I think is happening is if you look at the COT report, there's still a fair amount of longs still in the market. I like to, when I'm looking at the COT, I like to look at the figures and then divide them by open interest, because the open interest is always changing over time. And to give you an example, the net speculative position as a percent of open interest, that bottomed in 2013 at those two bombs I mentioned. I believe it bottomed around 5 or 6% each time. Now, the latest data, which was as of Tuesday, I believe was 24%. Now, that doesn't take into account the last 3 days of trading where we saw strong selling. So when the report comes out again, maybe it's going to be at 15%, 13%, who knows. But there's still a lot of people, a lot of longs who are in the market who have not yet sold. And, I mean, these are probably people who've bought in 2013 when we saw gold go below 1,300, and then there was kind of that weak double bottom. So there were some value investors and people who bought in, and gold did make that double bottom. So gold now is finally broken that weak double bottom that it had, and that double bottom started in summer 2013. So it's been a long while. And there's still, and as I said, if you look at the COT, there's still a fair amount of people in the market, and I think they're basically starting to capitulate. And there's just a lot more speculators in the market that need to be cleaned out, that are easily going to drive this market down to 1,000.
All right, I want to change.
Well, I'm sorry. I mean, more to add on to my answer. I do think what we're seeing now is just a total, kind of the start of a total liquidation. Where, I mean, to put it in other words, there were some people who came in 2013 and earlier this year, and they haven't, they had profits for a long time, small profits, and I think what we've seen in the last couple of weeks is really the start of everybody giving up. But I don't think that's going to be over like in the next couple of days. I think it's going to take at least several more weeks.
All right, moving forward, I want to look at Alan Greenspan's comments, and he told individuals at a conference in Louisiana and also reporters as well that he sees gold substantially higher in the next 5 years. Do you still agree with this assessment that gold will be higher based on what you're looking at right now? I know that we've had conversations off the air, and you told me that, yeah, I see gold going really higher from the levels that they were even 6 months ago, 9 months ago, 12 months ago.
Absolutely. I don't think the secular story has changed in the secular fundamentals. I mean, when you're looking at the fundamentals for gold, everything comes back to one point, and that's real interest rates. Gold is a currency, and it's an alternative currency, and when you can put your money in the bank and earn 4 or 5%, and inflation is only 1 or 2%, in that type of environment, there's no need for gold. But the reason gold has bull markets is, as we know, when the economy gets in trouble, and we have to go through a period of secular stagnation. Usually there's a lot of debt, and so what's the solution for that? Well, it's having negative real rates. And so that's what drives gold, and that's what we've seen for a long time. Recently what's happened is we had the rate of inflation peaked in 2011. That's gone down. interest rates until recently had gone up a little bit in 2012, 2013, so that caused that first big collapse in gold below 1,500. So that's really fundamentally explains what's happened in the last couple of years. Now, going forward, I mean, the key is, I believe, at some point we are going to see inflation take hold, and given the debt situation in the Western world, governments and central banks are not going to raise rates high enough to curb that inflation. And the reason is because they want rates to be negative in real terms, because that's what will help these governments alleviate the debt burdens over time. But the fundamental problem that gold has been having recently is, of course, we haven't been getting any inflation. Rates ticked up a little bit. So in the meantime, I don't really know what the fundamental catalyst is going to be. Is it going to be, I think it's either going to be inflation starts to take off at some point, or we see more stimulative policy. Maybe the Fed tries to do something new. They decide to not raise rates. They push that out farther into the future, and then we see inflation tick up. That could be something that fundamentally explains a turnaround in 2015 for gold. But really, over the longer term, I think all the monetary policies that we're seeing. I mean, now we're seeing the Bank of Japan get really aggressive. The ECB at some point will probably follow suit. And like I said, if we have more issues with our capital markets or with our economy, you'll see the Federal Reserve will definitely pump more money in. They'll telegraph to the markets that, oh, wait, the dollar's been really strong. We don't need to raise rates. So I think when you just look at those things, you can see in the next several years that inflation can start to pick up. And when that happens, because of the debt situation, none of these governments or central banks are going to raise rates high enough to change the fact that real rates will be negative. I mean, in other words, let's say inflation hits 3 or 4%, and rates are 0.25 or 0.5. Yeah, they might raise rates to 1%, but that doesn't do anything if the rate of inflation is going up faster. If the rate of inflation goes from 3 to 4, and then they only raise rates from 0.5 to 1%, real rates are becoming more negative in that scenario. So I think in the longer term, that really is what's going to push gold and push it eventually into a bubble. Is they're not, of course, the economy is very, very sensitive, and if we see inflation really start to pick up, policymakers are not going to raise rates fast enough. And given the debt situation, it's not smart for them to be driving up rates when the debt service costs are going to be an issue in the coming years. I mean, they want to keep rates low because it'll be easy to service all this debt. And, of course, if you keep rates low and you let inflation go up and rise, that reduces the value of your debt in real terms. It reduces the debt burden, in other words, whereas deflation is a debtor's worst nightmare because that increases the real value of the debt. So fundamentally, I think that's, I could be wrong. It could be something else. But I think that's what's going to set up or the renewal of this bull market in the coming years. And like I said, I don't know how the Fed is going to be able to stop inflation once it gets going. And I think that's eventually what causes this bull market to go into a bubble.
Going into my next topic, I want to look at the U.S. stock market. There's a lot of bullish sentiment going on in the Dow, S&P, etc., and you've covered this as well, not as frequently as you talk about the gold market. But if you look at the stock market right now, it's 17,400. Everyone around us is saying that they're bullish on the market. That's a red sign and a warning sign in my eyes. But how do you see the markets playing out? I mean, before you answer, I've looked at one chart, the dollar-yen chart, and I've noticed that liquidity is coming in from this yen carry trade into the U.S. stock market, and I've also seen the gold price get hammered since 2011 when you've seen the weakening of the yen. So I see that, okay, if gold prices go down, I'm assuming that the dollar-yen is going to continue to weaken, and that means that the markets may potentially go a little higher, but I think we're getting closer to a top. Do you see it that way?
Yeah, that's a good point. I mean, since we've had this bear market in gold in the last 3.5 years, gold and the stock market have been in a negative correlation. And so I think that's going to continue. But the question is, when is this going to flip itself? When are we going to see gold start to go up and the S&P stop going up, go sideways, and or start declining and fall into a bear market? Now, that's why it's very important to follow. You listeners can chart gold against the S&P. That's a very important ratio to follow and chart, because that will help signal when we do get a shift in that relationship. But clearly what's happening is, inflation expectations, they peaked in 2011, so we've seen all this money come out of commodities and those types of instruments, and they're going into the stock market because the economy, the fact that, it doesn't look like we're on the precipice and we're kind of past 2008, so people believe that things are okay. Yeah, I can put my money into a blue chip stock, but these companies are paying dividends, and so a lot of investors and retirees, they're getting yield with stocks that they weren't able to get at the bank, because of the super low rates. So the Fed policy and these global policies, of course, everybody thought they were going to create inflation, and we saw this huge run in gold from 2007 to 2011, and other commodities did really well. But with that backing off, all the money has just gone into equities, and now with the dollar strengthening, it's going into U.S. equities. And these companies, like I said before, these companies are giving investors and retirees a yield, whereas they can't get it anywhere else. So that really explains why the markets have done so well. And, of course, I mean, do I think we're in a topping process? Yeah, I think we're in a topping process. I mean, if you go back to 2007, we peaked October 2007. A lot of the early warning indications were coming about early 2007. You go back to the 2000 top, there were a lot of warning signs that really started to come in 1998. So when you have these negative breadth divergences and sentiment getting really extreme, it's possible that it can take And so what we've seen recently is we've seen these negative divergences, and the market had its first, I don't want to call it a serious decline, but its first real decline, probably the worst decline it's had since early 2012. And the market got very oversold on a short-term basis. We've had this sharp snapback. So I don't think the market is going to continue to make new highs in the coming months. I think we could see the market remain range-bound over the coming months, and maybe early next year we start to see the market challenge the recent low that it made. And, of course, as I was mentioning, that could coincide with a major bottom in precious metals. So it's tough. I mean, the stock market has really defied logic. It's defied the expectations of many, including mine. But I definitely think that it's begun some kind of a topping process. And obviously those can take a while to form. But I do think that we are going to see a bear market start in earnest probably sometime maybe around the middle of next year, maybe a little bit sooner.
The thing is that in October 2007, you started to see oil prices rise up, and ever since then, the market went down. 2000, we saw a rate hike, or we saw the Fed funds rate go to around 6%. right now we don't see the Federal Reserve tightening. I mean, some people might say, hey, it is tightening because they're ending QE, but rates are still at zero. And now it just seems that the central banks are just playing musical chair while the Japanese central bank is putting in liquidity to our market, and then the ECB may be flooding liquidity all around the world. So I don't see the catalyst yet. I mean, I see oil prices going down. Even though I'm short right now, the market, I'm just seeing a hard time for the market to go down now. But I don't know what the catalyst will be.
Well, that's a very good point, because yes, oil prices do look very weak, and that's going to help the economy if oil prices continue to decline. And that's why I said I think if we're looking out over the next 6 or 8 months, we could probably see some kind of a trading range in the broad markets. I mean, it'll, given the sentiment and given the extreme rally we've had over the last 5 years, and given the negative divergences that we talked about, it seems unlikely that the market is going to be able to keep making new highs. Yet, because of the things you mentioned, you could say it seems unlikely that the market is going to break the recent low. So that's why, if I had to guess, I would kind of err on the side of saying that maybe we're going to have a trading range over the next couple quarters.
Yep, we shall see. But I'm looking at this yen carry trade, which for the past 3 years has determined the direction of the stock market and the gold price. So if you're saying lower gold prices, I still see potentially a higher stock market, but then it's going to reverse. But anyways, Jordan, before I let you go, how can people follow your work again?
They can visit my website, thedailygold.com. They can email me, jordan@thedailygold.com. They can sign up for my free newsletter at thedailygold.com, and that kind of talks about the things that I do, and it gives some samples from my premium newsletter.
All right. Thanks for coming on again, Jordan.
Thanks for having me.